This is Tom Aspray with the Viper Report. In this weekend's market video, I'll try to answer the question about which stock market warning signs I find important. Pretty much those people who have missed the rally from the April lows are, they find the same warning signals now as they did then. Too high a valuation, lots of fundamental stuff. But of course, I deal with the technicals. Those of you who've seen my videos before know that the advanced decline analysis is a big part of that. So, if the daily, AD lines turn negative, they move into the correction mode. The weekly, that's a more serious correction. And of course, as was the case in late 2007, when the monthly AD lines form divergences and turn negative, that's bear market time. So we have a nice picture of a bear here. So in today's, let's look at the focus of the weekend article for Forbes. One of the more valuable reports that I view is from the Bank of America. They do a monthly survey of fund managers. It's called the FMS survey. Lots of data, some contrary, some not. But one I pay particular attention to is the cash levels. Okay, why is that? Well, oftentimes when cash levels are quite high, for example, in October of 22, it's like over 6%. I've never seen, a situation where you had that high cash levels and you had a bear market. Conversely, when they're down under 4%, that's more of a warning sign. This chart, I think, is quite important. I'm sure many of you do remember the big slide in growth stocks that started in late 2021 into early 22. It was a pretty serious decline, and that last push to the downside, in October of 22, was sort of a water said a moment that a lot of people got out of their stocks, and many of them have not gotten back in. So you can see as the peak was forming, cash levels at 3.9%. Below here we have the differential between the bullish percentage in the AAI survey and the bearish. Okay, so right near the peak there were 25% more bulls than bears. So the difference, if you subtract the bears from the bulls, was 25. We had this decline. You can see that, it's a very orderly. We hit this is the yearly pivot. I have another article I'm working on. I'll talk more about the yearly pivot analysis. Then we had another good rally in August, and then we had a decline into October, and at that thing, which cash levels had gone to 6.3%, as I told one of my students at that time, and down at that point there were 40% more bears than bulls. So that bull minus bear reading was at minus 40 or lower. So that was a sign that, pretty much the sentiment was so negative, it was time to look for buy signals, which we got from the AD line analysis at that time. So we follow it into 23 in July. There was a key reversal up here. So we'd gone from 6.3 down to 5.3 in terms of the cash levels. And, these AAI numbers at that peak in July were 29.8% more bulls than bears. So that switched around quite dramatically. The long side was getting quite crowded, and that started a pretty significant decline. Went a lot lower in October here than most of us thought. Even some of the few people who were still bullish like I was were starting to wonder, and we got 25% more bears. So 29.8% more bulls up here. So it did just what a correction is supposed to do, or a pullback. Change the sentiment. I'll include a link to this article in the description. So last week the action was mixed. Looking at the month, it's pretty interesting. So far in August, looking 1 month back, utilities have been the big winner. Who would have guessed that? Up 6.4%. NASDAQ 100 up 4. Gold is up 2.9. S&P is up 2.6. And the rest of the averages, New York Composite down slightly, as is the industrials. A few people are commenting about the negative action of the Dow industrial stocks. which I am watching. IWM, the small caps down 0.42, and transportations have really gotten hit. So looking at the stock charts, we have the New York Composite weekly. It just had a pull back into the breakout level. This is line A. We have hit the yearly R1. So, but the 20-week moving average is not that far below. We closed at 20,524, and this is at 20,029. So 500 points below, this level is stronger support. The S&P weekly AD line, it broke out not that far off the lows, and still looks very strong. Turned up last week and showing a pattern of higher highs, no divergences, and the NYSE AD line is telling you the same picture. Of course, the QQQ has been our favorite since the late April, early May bottom. You can see the NASDAQ 100 AD line broke out, in April, May. It's still leading prices, no signs of a top here. If you look down here, it's the relative performance. Shows that it's still a market leader. So it still favors growth stocks, over value. And we get into the watch list, you'll see that data is confirming that. If you look at the daily, you can see we've hit the R1 for August early at the end of the month, start of the month rather, reversed downwards. We took some profits in our TQQQ position, but are still long the QQQs. You can see the 80 line just barely above it. It's pulled back from the highs, but not, if we were to break these lows, there's sort of a target zone here. Relative performance, we just looked at the weekly, daily here, just has made a new high. So that looks strong in favor of growth. We also look at the ratio of IWF, that's the Russell 1000 growth ETF, versus the Russell 1000 value IWD. So when this is rising, growth's leading. When it's falling, like it did in 2022, that was a correction we just looked at in terms of the cash levels. There were some clear signals at the end of 21 that it was time for value, to rebound, or in this case, the way this chart is plotted, for growth to decline. So new highs in the last couple of weeks. So we broke out above these peaks. That is, significant. MACDs are still strong. So suggest a pullback when we get it, which is likely. I would think in the next month, by the end of September, that growth will probably take a breather. We look at the daily chart of the SPY. You can see we have this nice support here right around 621. We're holding the new pivot, which is 642, or regular 629.15. With the R1 up here at 642.78, and then 653. Targets we've been talking about for a while. Moving averages are all pretty strong. You can see that the 20 period, we were talking way back on here that this was really a strong buying opportunity based on the market internals, as well as the slope of the 20 period exponential moving average. So yeah, could we get down to the 50-day? That's what a lot of people are looking at. So that's at 615, and we're at 637. So 20 points, that's about a 3% pullback. S&P AD line is still positive support here. So if we break that support, there's lots more support down further. Stocks only, is the only one that's negative right now. It's below its moving average, but the NYSE All AD line is still positive. Put call ratios are low. You can see we had a little spike up here at the start of August. We had that one-day decline, and the put call moved slightly above 1, so that was more puts were being bought that day than calls. Index is really not seeing any sort of low such as what we saw in April. So that was a sign that the market was flushed out. Everyone was buying puts in a fear of this last push down, probably, unless they were quick, took a bath there. High-low analysis, still positive, though of course, we're seeing longer-term divergences, but we haven't got any really sell signals on a short-term basis. What I look for here, so 61 new lows, 98, it's been higher. So, if we start to see a push above 200 new lows on the NYSE, that would be a concern. There's a similar picture for the NASDAQ Composite. You can see we've moved higher, and there's been a slight decline in the number of new highs, but no real pickup, other than on that Friday drop in the number of new lows, which was, about 250. So we get 122 on Friday, so we get them start to move above 250. That would be consistent with a correction. The volatility popped at the start of the month. You can see that's a spike here in the VIX and the VXN, which is for the S&P or NASDAQ 100. So this is kind of the resistance levels I'm watching. They're back below their moving averages, but you can make a case that it's trying to bottom. So here are the breakout levels. Way back in here in February, we were looking at these twin peaks here, and we pushed above at the end of April, or end of February rather, and that was the start of a pretty good correction. So this chart's another great example of why you should pay attention not only to the 20-period EMA, but also to the slope of the EMA. So let's jack this line up a little bit so it's a little easier to see. And you can see the solid red line right up to March. We got a perfect little rally right up in here. And I think if we put the pivot levels in there, which is what I teach in terms of integrating all this together. Let's see here. Okay, well, I guess we don't care about the color. So here you can see that we had the the pivot level back at that point was right. We made it up to the S1 here, and we were below the pivot for all of March. So the correction here dropped below the monthly and stayed below it until after the April lows. So it gives you some good lines of what happens here. So you can see that for 65.53 and the S&P, and also at the S1 at 62.02. This candle glance chart is pretty much the majority of the holdings in the Viper ETF report. Let's look at some of these markets independently. I think I've mentioned. Let's look at what happened last week in terms of the. I know some of you. I thank you for your kind comments about my knee surgery. Appears to have gone well. That's the good news. The bad news is that more is likely to come as we enter the fall. So quite a bit of still a very high level, 86.3. Closed above their pivots. We talked about just in this video about the correction started in July of 2023. At that point, they're about 86.3%. The ETFs are also above their quarterly pivot. So, that's a bullish reading, but, something that needs to be watched. So, and when I see those cash levels, those put me on the alert that, to start taking profits on strength, because, so far the markets have been tolerating the craziness and the tariffs, but I don't think that'll last until Halloween, that's for sure. So still a preponderance of growth, over value. The value has improved. You can see this chart here is the SPXL, that's the triple S&P leveraged ETF. Just gave a buy signal on Friday, so that's a good sign. And it looks like this little pullback here that was into the August 1st low is over. So, you're watching support at those lows and a bit lower. From the rundown of the various sectors, you can see, only the real bright spots are the utilities, followed by, the XLC, which has long been a favorite. We got down to 58, back up to 63.8, and XLK is still positive, but, it used to be up here in the 91 area, just, well off the lows. That was in early May, and that was a sign when we went from 33 to 75 to that was the time to be, okay, let's buy XLK, which we do. We're still holding about, I think we sold 25% of it, but we're still holding on to it, but managing the position. So not a lot of, other, oil took a hit again down to 51.7. Over the past 3 months, only XLK, has done better than SPY. And of course, XLV is still the loser for the period. And last week, in the report, we show that 3 sector ETFs outperformed the 2.4% gain in the S&P. XLY, XLK, and surprisingly XLP, which of course is a more defensive play. So also some new, weekly and daily signals in that XLP, as well as EAF. That's the European stocks. Daily signals. Technology flipped back to a daily positive, as did the SPY, semiconductors, and the direction. The 3 bullish ones I just talked about on the charts. It all flipped to positive. So in terms of the relative performance, a little loss of momentum here in the industrial, so I'm watching that. Consumer discretionary, if you look at a downtrend across those peaks, I'll be looking for that downtrend to be broken as a really bullish sign. Technology still looks strong. You can see this goes back into April, or May, late April, early May. And, the slow, as the fast and green has been well above the slow. Manufacturing, XLC took a bounce here, so is this part of a further decline? I'll be watching next week's numbers. Also, recently I've been including in the ETF weekend report the readings for some of the Vanguard. I know that's what I use actually in my retirement account, so in managing the different sectors. So once again, the staples there, and FTS, developed country. Their symbol is VEA, also gave a 3-day, and Europe was nice, and as did this total stock market. So it helps you keep track of those, from not a switching service, but just a longer term hold. Looking at the sector report here, you can see that energy has been a tough trade here. Some new positive signals there, but a lot more red here. VLO, Valero usually is a pretty good leader of the whole group, and you can see it's pretty much all red there. XOP, is another one I follow in terms of ETFs, and it hasn't been doing all that great either. So materials, 58.3. So, ECL had both a weekly and a daily. That's something to watch. Industrials, you can see GE, aerospace flip back to a 4-hour. So if that's all the rest of it's green, so that may be a good short-term signal. UPS and UNP both are in the red. Consumer discretionary, Tesla seems to be trying to roar back, along with Target. What a combination. And McDonald's and Starbucks are also, Starbucks is looking a little bit better here. So 58.3, that's a positive reading overall. Consumer staples, I mentioned that, it gave some weekly and daily buy signals and just crossed above the short term above the long term. So we're in XLP, and so I'll be looking at some of these. Costco, give it a 3-day DTS, Dollar General, and Coke. Healthcare, still looking sickly. And let's see down here. And financials is kind of a tough call. You can see the RS has really been in a downtrend, but there's been some bright spots here. So MA is MasterCard, Morgan Stanley flipped to green, and but it's sort of a mixed bag. JP Morgan gave a 3-day sell, whereas Bank of America and Wells Fargo were already in the 3. So this may not bode too well for financials in the week ahead. Technology, 58.3, but you can see where, if we're going to get more gains, you can see where we'll be looking at, Adobe into it, and Apple, we're long Apple in the stock service, and it just gave a weekly and a daily. That's a good sign. And utilities, not a lot of SO, could be coming back around. But look at some of those charts, and pretty strong readings at 91.7. Not so much XLRE, which is kind of the opposite case. You can see all the red here. So that suggests it's still in a declining trend. In closing, I hope you get a chance to read the Forbes article. Basically focusing on the cash levels. So a sell signal has been generated based on BFA, though they tend to filter their signals. So it's I don't really, of course I use different technical readings. So that level of under 4 has me watching for more signs from the AD lines that we're in a corrective period. There have been since 2011 17 instances of this sell signal, and the median S&P return for the next 4 weeks was -2%. So that's not surprising. When they're and we did see some very high levels or very low levels of cash at the major top in 2007. So that's something to pay attention to. If you're doing more buying, do it selectively. Do not think more than about 70% invested, and we'll be pairing out, selling at pivot resistance as we head into September. Hope you enjoyed this, and I think we're back on a regular video schedule. Thanks again for all your kind comments.